describe accounting methods, choices, and estimates that could be used to manage earnings, cash flow, and balance sheet items. The major takeaway from this section is that there are a wide variety of ways and means by which management can influence the results that wind up in their financial reports. Some are geared towards affecting the balance sheet or the statement of earnings, while others affect the reporting of cash flows. Some in turn intend to show an increase in performance, maybe to push up the numbers to make a weak period look better on paper, while other choices influence a decrease in performance to ensure that investors don't get overexcited about a short and temporary period of outperformance. Let's look at some examples. Let's start with choices that can affect earnings and the balance sheet. We have 6 major stopping points here for earnings and the balance sheet. We might think of revenue recognition, inventory management, accrual accounting, deferred tax assets, depreciation, and the capitalization of expenses. Okay, revenue recognition. Choosing when to recognize revenue. Let's say, for example, we are exporting goods. We have a significant order hitting the docks, ready to be shipped near the end of the period. If we have agreed with the international buyer that they are responsible for the goods once they have been loaded on the ship, then we would recognize revenue before the end of the period, so that order would be included with this period's overall revenue, increasing performance metrics for this period. On the other hand, if we go for a deal whereby we maintain responsibility for the goods while they are in transit, then we will not be recognizing revenue until they reach their destination. The net result then being that revenue for the period will not include this order and performance metrics stay as they are. This has the knock-on effect of adding to next period's figures, so we have a nice chunk of revenue for next period's accounts before it even starts. Management might be able to influence a decision between these possibilities on the fly so as to achieve these changes in revenue recognition as they see fit in terms of what they want the performance numbers to look like. Next, inventory. How is the cost of a company's inventory set out in their accounts? We have 2 options here: FIFO, first in, first out, or weighted average cost. If you're wondering about the LIFO method, last in, first out, it's not permitted under IFRS, so I'm not going to discuss it here. Now, when prices are moving, with FIFO, the cost of goods sold figure will be out of date based on historical prices from when the inventory was accumulated, but we will have an accurate depiction of the current value of inventory, since the most recent purchases will still be on the books. This makes the balance sheet more useful for investors. With weighted average costing, the cost of goods sold is closer to the current fair valuation, but the balance sheet is not as close to the current market value of inventory. During times of rising prices, weighted average will understate the value of inventory, and during times of falling prices, the value will be overstated. Accrual accounting, as we have previously discussed, is a method of reporting current period activity as opposed to current period cash. Now, although cash may not change hands in the current period, revenues and expenses should be recognized when they occur to maintain an accurate and up-to-date picture of the company. Unfortunately, there are many ways in which management can use the subjective areas of accrual accounting to push reports closer to what they would like than a completely neutral reflection of reality. For example, if a company is selling goods on credit, they may have a provision for uncollectible accounts, goods that have left the company where we don't expect to be paid. But where do they get that number? How can they predict with any level of certainty how much of their credit sales will become uncollectible? And since there is no certainty, how much of that number is being managed and how much of it is genuine reflection of reality? Okay, deferred tax assets. When a company generates a net loss for a period, they will add a deferred tax asset to their balance sheet for the next period. This means that in the future, if they generate a net profit, they will be able to use their deferred tax asset to deduct from their tax bill. There is room for subjective judgment when it comes to the valuation of that deferred tax asset, because this figure is intended to accurately depict the value of the asset that will be used. It's quite possible that this company will never earn enough profit in the future to ever actually use up the deferred tax asset they accrued in the first place. It all depends on management's forecasts for the future of the company. A startup may take off and use their entire deferred tax asset. That's fair. A company that hit a bump in the road may recover and also use up the entire thing. But what about a company in decline? One that has just fallen to a new entrant and is expected to go out of business inside the next 5 to 10 years. Will they ever use that entire deferred tax asset? And if not, they cannot hold it in full on the balance sheet. How much they choose to hold is a great indicator of management's outlook for the future. Depreciation, methods of apportioning the cost of a long-lived asset to the multiple years we see a benefit from it. There are 3 major methods: straight line, accelerated, and activity-based, and we also have the consideration of salvage value. The choice of any method and any salvage value could potentially be justified by the management, and at the same time, one choice over another could mean vastly different performance results. Last one here for earnings in the balance sheet is capitalization. This centers around the fact that management must discern whether an outgoing payment benefits only the current period, meaning that it is an expense, or does it benefit multiple periods, meaning that we capitalize and make it an asset that is written down by usage. Bias in this regard, where management have the opportunity to defer expenses into a future period by capitalization, brings about the possibility of lower quality reports, and this is where the analyst needs to be careful. Okay, moving on then, let's talk about accounting choices that can be made to influence the statement of cash flows. Here we are going to quickly look at the importance of cash flow from operations, and then we'll talk about comparing cash flow to earnings. We'll look at accounts payable management, and we'll finish off with a discussion of misclassifications. There are 3 elements to the cash flow statement: CFO, relating to operating cash flows; CFI, relating to cash flows from investment activity; and CFF, relating to cash flows surrounding financing activities. CFO is seen as a reality check on the firm's reported earnings. When we question the validity of a company's accruals or depreciation, cash flow is seen as a less easily manipulated measure of the company's operating performance and a vitally important source of insight into the overall quality of a set of reports. One method we can use to assess the quality of a company's operating cash flow is to look at the company's earnings in the same period. So how do we assess a company's ability to generate cash? One possibility is to look at the relationship between net income and cash generated from operations. When the amount of cash generated by a company in a period exceeds their net income for that period, then we have good quality earnings. If, on the other hand, the company is reporting net income far in excess of cash generated, then we have a red flag. This is a sign that choices have been made to improve net income rather than simply depicting financial reality. Since cash flow from operations is such a widely used measure of the performance of a company and the quality of its earnings, it is common for management to seek out ways of improving their report in terms of cash flow generated. One method by which this is achieved is by managing accounts payable. This whole idea comes down to management's ability to pay or delay. If they choose to pay sooner, then cash is gone. The balance sheet liability for payables is also gone, but here we're focusing on cash flow, and cash would be falling by the amount spent. On the other hand, if they choose to delay and not pay their supplier temporarily, then they retain that entry for payables on the balance sheet, but the number we care about, the amount of cash generated in the period, well, that's going to be higher because there is still cash in the company on the reporting date that by neutral financial reality should have been paid out already. Finally then, misclassifications. Another method of improving the appearance of cash flow generation is to misclassify items from investing or financing activities to bring more cash inflows into the operating side, and maybe move out some cash outflows. This might be achieved through the construction of some complex financial transactions or agreement structures, which is an even worse sign that management are willing to manipulate their reported figures.